Hello, good morning, good afternoon, good evening. My name is Junewoo Lim, and today I'll be presenting my findings for CLA 2 in FIN 601 course. This presentation will summarize key insights from my financial analysis and strategic applications, incorporating key learnings from PA1, CLA1, PA2, and CLA 2. Before diving into the details, let's take a look at the structure of today's discussion. To provide a clear roadmap for today's presentation, I have structured it as follows. I will start with an executive summary, offering a high-level overview of the key financial insights. Then I'll go into financial ratio analysis, followed by forecasting techniques and venture financing considerations. After that, I will discuss business valuation and exit strategies, integrating findings from PA4. I will also highlight my key findings from CLA 2 and how these concepts apply to my role in Treasury and Finance. Finally, I will conclude with a summary and take any questions if there's any. Now let's move to the executive summary to get a snapshot of our key takeaways. In this presentation, I'll discuss critical financial principles, including financial ratio analysis, forecasting, venture financing, and M&A strategies. These insights help in evaluating business performance, making investment decisions, and planning corporate financial strategies. We will first look at financial ratios and how they assess a company's profitability and efficiency. Then we'll examine forecasting models, particularly sustainable and internal growth rates. Moving on, we'll discuss venture financing, highlighting ownership dilution and investor returns. Lastly, I'll introduce M&A strategies weighing liquidation against acquisition benefits. Now that we have a high-level overview, let's move into the first major topic, financial ratio analysis. A key component of financial analysis is ratio evaluation, which I applied to NVIDIA and Kroger in PA1. Here are some key observations. Liquidity. NVIDIA has a stronger financial position with a current ratio of 1.12 compared to Kroger's 0.81. For profitability, NVIDIA leads with a net profit margin of 25%, significantly higher than Kroger's 1.9%. Efficiency-wise, Kroger's asset turnover, 2.97, outperforms NVIDIA's 1.72, showing that retail businesses operate differently than tech firms. While these ratios provide key insights, we must also recognize their limitations. Let's transition to the next slide to explore these challenges. Although ratio analysis is useful, it has certain limitations. First is industry differences. A tech company's financial structure differs vastly from a retail firm's. Second is accounting methods. Variations in accounting policies, such as FIFO, LIFO, can distort ratio comparisons. Third, seasonality. Retail businesses have seasonal revenue fluctuations that financial ratios might not fully reflect. Thus, while ratio analysis is a powerful tool, it must be complemented with qualitative assessments. Now let's shift our focus to financial forecasting, which plays a crucial role in long-term planning. Financial forecasting helps businesses predict future financial needs and optimize resource allocation. The four-step forecasting process includes first, historical analysis, identifying revenue and cost trends. Second, market and industry analysis, evaluating internal economic conditions. Third, internal assessment, reviewing business-specific factors like pricing and production capacity. Fourth, forecasting models, applying statistical models to project future performance. Forecasting is critical in determining how businesses sustain growth. Let's explore how growth rates factor into this process. When assessing financial growth, two key metrics are used. First, sustainable growth rate, so-called SGR, the maximum growth a firm can achieve without additional financing. Second is internal growth rate, IGR, the highest growth rate possible using retained earnings only. For moves towards Inc., a projected 20% sales growth required an additional $79,163 in funding, emphasizing the importance of balancing growth expectations with financial resources. Now let's transition into the next major area, venture financing. In PA3, I explored venture financing and the due diligence process. Successful investment decisions require first market and industry analysis, understanding trends, competitors, and regulations. Second, financial analysis, examining key financial statements. Third, management review, evaluating leadership and operational efficiency. Fourth, legal compliance, ensuring regulatory adherence. These steps ensure well-informed investment decisions and risk mitigation. Let's now look at how venture financing affects ownership structures. One of the biggest concerns in venture financing is ownership dilution. My analysis showed that an initial $2 million investment resulted in a 4% investor ownership stake. A second round $8 million investment led to a dilution, reducing founder ownership to 88.8%. This demonstrates that securing additional funding often comes at the cost of ownership. Next, let's discuss liquidity management through factoring receivables. Companies sometimes sell accounts receivable to improve cash flow, but this comes at a cost. The advantage is the immediate liquidity. However, the disadvantage is a discount fee of 7 to 10%, reducing revenue. Factoring receivables should be used strategically, considering its impact on financial performance. Now let's transition into business exit strategies. A key part of financial decision making is determining the most effective exit strategy. In PA4, I explored two main options. First, systemic liquidation, a structured asset sale that provides predictability but can be time-consuming. Second, acquisition, a strategy that resulted in a higher valuation due to synergies, raising ACE valuation from $57.8 million to $61 million. These insights highlight the financial trade-offs business must consider when planning an exit. In CLA2, I examined financial forecasting and exit strategies in greater depth. The three major takeaways were: first, the importance of accurate forecasting in corporate finance; second, trade-offs between liquidity management and investment risk; third, the implication of ownership dilution in venture financing. These financing emphasize the need for strategic decision-making in business finance. Now let's shift our focus to how these insights apply to my career in treasury and finance. The financial principles covered in this course directly align with my current role in treasury and finance. Key applications include: first, financial ratio analysis used for liquidity assessment and credit risk management; second, forecasting models essential for budgeting and financial planning; third, due diligence and investments helps evaluate vendors and investments risk; last but not least, exit strategies important in financial restructuring and M&A. By applying these concepts, I can contribute to better financial decision making in my organization. While financial models provide valuable guidance, they are not without challenges. Key considerations include market volatility, data accuracy, external risk. Economic fluctuation can impact forecast and valuation when it comes to market volatility. And financial statements are based on assumptions that may not always be reliable in terms of data accuracy. And for external risk, factors like regulatory changes and geopolitical events can influence financial outcomes. So, understanding these challenges ensures that financial models are applied with caution and adaptability. In summary, this presentation covered key financial principles, including the role of financial ratios in evaluating performance, how forecasting models help business plan for growth, the impact of venture financing and ownership dilution, and the trade offs between liquidation and acquisition strategies. Financial analysis is essential for corporate decision making, and applying these concepts in real world finance ensures effective strategic planning. And here are the reference. Thank you so much for your time, and if you have any questions, please let me know. Thank you.